Welcome to Talk Tickers. We dive straight into earnings calls to pull out the key info you, as savvy investors, need.
That's right. No fluff, just the essentials.
Today, we're zeroing in on Ventas. They're a major REIT heavily involved in senior housing.
Yep, VTR. And their latest earnings call just dropped.
So our mission today, cut through the jargon, get you the clear picture on their performance and what they see coming down the pike.
Okay, let's jump right in. The big headline from Q1. Strong results, really solid.
How? Give us the numbers.
Well, normalized FFO per share, that's funds from operations, a key REIT metric, saw a significant jump compared to last year.
Okay, FFO up. What else?
And Same Store Cash NOI, net operating income, showed really solid growth across the board.
Across the whole portfolio?
Pretty much, but it was particularly driven by their senior housing operating portfolio. They call it SHRP.
SHRP, got it. We'll definitely need to dig into that and their outlook.
They seem optimistic. They actually reaffirmed their full-year guidance for normalized FFO per share growth. So confidence is there.
All right, let's unpack that SHRP segment then. You said it was the main driver.
Absolutely. The year-over-year cash same-store NOI growth in SHRP was, well, exceptional.
What's fueling that? Just filling rooms?
It's two things, really, both occupancy gains and rate increases. They're getting more people in and they're charging more.
Ah, the golden combination.
Exactly. They mentioned strong underlying pricing from internal rent bumps, like around 7% on average.
7%. That's just some pricing power, doesn't it?
It really does. And it's not just existing residents. The rates for new residents, the street rates, are also trending up. That points to continued revenue growth.
Any other factors helping SHRP?
Yeah, they actually noted that labor expenses were favorable during the quarter. Yeah. Which is, always a positive.
Good point. Labor's a big cost there. So occupancy specifically, how much growth are we talking?
Significant same-store SHRP occupancy growth, particularly strong in the U.S. market.
But is there a but?
Well, a small one. They did see some seasonality. March had sort of elevated clinical move-outs.
Clinical move-outs? Meaning?
Residents needing a higher level of care, unfortunately. So that impacts the starting point for Q2 occupancy a bit.
Okay, a slight headwind starting Q2. But they still reaffirmed the full-year guidance for SHRP.
They did, which suggests they're confident they can manage through that seasonality and, hit their targets for the year.
It sounds like they're not just relying on the existing assets either. They're actively managing the portfolio.
Oh, definitely. They're enhancing the mix through acquisitions, selling off some assets, and importantly, converting more properties to that SHRP model.
Conversions? From what?
Often from triple net leases. And a big piece of this strategy involves converting a large number of Brookdale communities over to SHRP, but with new operators.
Interesting. Bringing in new management for those Brookdale sites. Why?
They expect substantial NOI growth from that. The idea is these new operators bring fresh expertise, maybe a different approach. Plus, they've significantly expanded their operator base overall from like 10 to 33 partners.
Wow, that's a big jump. Diversification.
Exactly. It spreads the risk and lets them partner with specialists in specific high-demand markets. They even mentioned a new relationship starting up in the UK.
Going international with it, too. Are they investing in the buildings themselves? Upgrades?
Yep. They have an ongoing community refresh program. It's about making the properties more competitive, more modern, which should help drive future NOI.
This all feels very connected to the demographic story, right? The aging population.
Precisely. Ventas is clearly positioning themselves to ride that wave, the growing over 80 population. And critically, this demand surge is happening when new senior housing supply is pretty limited.
Right. Demand up, supply constrained, basic economics.
And they also made a point to say resident affordability remains strong, which helps sustain those rate increases we talked about.
Okay, let's shift to investments. Acquisitions. Have they been busy?
Very. Significant investment in senior housing acquisitions, both this past quarter and looking back over last year.
Are they just buying anything, or is there a specific strategy?
Oh, very specific criteria. They're looking for certain year-one NOI yields, good unlevered IRR potential, that's the return before debt growth, that's accretive, and crucially, buying below what it would cost to build new today.
Buying below replacement cost, that's key in real estate. What kind of properties?
Generally newer vintage communities located in markets with strong net absorption. They mentioned Texas as one area. They're increasing exposure.
Seeing any changes in pricing for these assets? More competition?
They did note some cap rate compression, meaning prices are going up relative to income compared to last year. So yes, maybe a bit more competition.
But still finding deals.
Yeah, they said the pricing is still within their target range. And with construction costs rising, buying existing assets below replacement cost looks even more attractive.
What about future deals? Is the pipeline still full?
Active and growing, apparently. Enough so that they actually increased their full-year investment guidance, still focused primarily on senior housing.
How are they finding these deals in a potentially more competitive market?
That's interesting. They said the majority of their closed deals were relationship-driven, sourced off-market. So their network and reputation seem to be paying off.
Okay, let's touch on their other big segment, outpatient medical and research, OMAR. How's that side doing?
Outpatient medical delivered solid compounding growth. Pretty steady.
What's driving that?
Again, demographics, the growing over 65 group, but also the trend of shifting care to lower cost outpatient settings. Occupancy and tenant retention look strong there.
And the OMAR, the research part.
That portfolio saw a modest contraction in Same Store Cash NOI, mainly due to a bit lower occupancy in a few properties.
Any major concerns there?
Doesn't seem like it. They reaffirmed the full year guidance for OMAR overall. And remember, that research portfolio usually has long-term leases with strong tenants, like universities. Pretty stable overall.
Good context. Let's talk financials, balance sheet, debt. How are they positioned?
They've definitely made progress strengthening their credit profile. They highlighted reductions in leverage and boosted liquidity.
So more cash on hand, less debt relative to assets.
Basically, yeah. And they've also managed to refinance some debt at better rates. So overall, they seem financially flexible and pretty robust.
Okay, let's summarize the outlook again. What are they telling investors to expect for the rest of, looking towards 2025?
They reaffirmed that full year 2025 guidance for normalized FFO growth, targeting around 7%. And they expect SHRP, that senior housing operating piece, to be over half their total NOI by year end.
Wow, so senior housing is really becoming central to the story.
Absolutely. They acknowledge the macro uncertainty out there, of course, but they feel senior housing is really well positioned because of those demand-supply fundamentals we discussed.
What else are they expecting?
Continued SHRP revenue growth from both rate and occupancy. Limited impact from things like tariffs or global trade issues. And they expect the second half of the year to be stronger for SHRP than the first half.
Why stronger later in the year?
That's typically the key selling season for senior housing. Plus, they believe there's still significant occupancy upside left in a big chunk of their U.S. portfolio. It's about optimizing price and volume.
Any other strategic moves on the horizon?
They mentioned actively looking for more creative conversion opportunities, turning triple net leases into SHRP assets, like that UK example.
And competition for assets. Is that a worry?
They acknowledged competition for good senior housing properties is increasing. But they believe their platform, those relationships we talked about, and their financial strength give them an edge.
One last thing, those clinical move-outs in March, how big a deal was that?
They basically characterize them as unpredictable, sort of a blip, but importantly, offset by strong move-in activity. So not derailing the overall positive trend.
Okay, so bringing it all together for an investor listening, what's the main takeaway here?
I think the core insight is the really compelling growth story in senior housing, driven by those strong demographic tailwinds and limited new supply. Ventas seems strategically focused on capturing that.
And their SHRP strategy seems to be working.
It certainly appears to be paying off with significant organic growth. And their increased investment guidance shows confidence they can keep finding good deals. Plus, you have the stable OMAR portfolio providing diversification.
And the stronger balance sheet reduces risk.
Exactly. It gives them the firepower to pursue these growth plans.
All right. Time for our favorite segment. This is not financial advice.
We take what we've heard and spin up a, let's say, creative trade idea. Given Ventas' deep dive into senior housing, what have you got?
Okay, buckle up for this one. It's a bit out there. How about going long Ventas, VTR?
Okay, that part makes sense based on our discussion.
Paired with a short position on a major publicly traded cruise line operator.
Whoa, okay. Long senior housing, short cruises. Explain the logic there. That's unexpected.
Well, think about the underlying driver for Ventas,
Yeah.
the aging population, right? That same powerful demographic trend could arguably be a headwind for industries heavily reliant on discretionary spending from older demographics, like cruises. So the idea is, as people age, money shifts from leisure travel towards healthcare and housing needs.
Potentially, yes. Or at least the growth focus shifts. You're betting that the non-discretionary need for senior housing, where Ventas is strong, will outperform the highly discretionary spending on something like a cruise, especially as that large demographic cohort ages further. It's a play on shifting priorities within that aging demographics wallet.
That is definitely a speculative take on demographic spending shifts. Very interesting.
But now, the giant flashing warning sign.
Absolutely crucial disclaimer time. This is purely a speculative thought experiment. It is not financial advice in any way, shape, or form. It carries significant risk.
Seriously, do your own extensive research. Talk to a qualified financial advisor before even thinking about making any investment decisions based on wild ideas you hear on the internet.
Precisely. The performance of Ventas, cruise lines, the whole economy. It can all be affected by countless factors we haven't discussed. This is just connecting some dots, maybe provocatively. Understood. Provocative is the word.
So, wrapping up our deep dive today, the picture from Ventas' earnings call is one of a company leaning hard into the long-term growth story of senior housing.
Yeah, the strong Q1 results, the active investment strategy, the focus on improving their SHRP operations, those are definitely the key things for investors to chew on.
But remember, what you heard today is our distillation. It's a snapshot.
Absolutely. For the full picture, you really need to look at the complete earnings call transcript, read their filings, do your own homework.
We'd love to hear what you think about the senior housing market or Ventas' strategy. Feel free to join the conversation and share your insights.